Well, good evening, folks. Welcome back to the channel. Boy, do I have some very exciting content to discuss today. Uh, it's been a couple days since I've uploaded a video. Lots been going on behind the scenes, but I've discovered a potential game changer for passive income, potentially $1,000 a week in easy money. And it comes from a strategy that I've talked about before that I've known about for a couple years and just never quite applied it until now. And now that I've fully realized the potential, a massive light bulb has gone off. And I hope that this video can have the same impact on some of you watching as it did for me, because this could be a game changer. So this has to do with what I've discussed before in a short video. I've mentioned the Warren Buffett infamous $7.5 million in under 5 minute strategy. And the funny thing is, and this is kind of what I do, like I'll talk about things and I get them in concept, but actually applying the concept, there's like a delay for whatever reason. And I'm trying to get better about that. But delaying the application of stuff can cost you, as you'll see. But as long as you learn and as long as you understand it, it's never too late. It's or as they say, better late than never. But anyway, so in theory, when you hear about the famous Warren Buffett $7.5 million in under 5 minutes, that sounds very intriguing. But most people will say, "Oh, Warren Buffett, he's already rich. Like, why even bother paying attention to what he does? He's got so much money anyway." But a smaller segment of people will ask, "How did he get there?" And that is what you really need to focus on, because if you want to acquire more money and more wealth, you have to try to emulate what the wealthy do. They invest, they take risks, they do things like this. And it's a shame that the vast majority of people will look at something like this and say, well, Warren Buffett, he's rich. Like I could never possibly emulate what he does. But that's where you really need to stop and think and cut out all the noise and cut out the negativity, because a lot of this is a mindset game, and you have to be in tune with what you hear, what you read, and you have to really cut out distractions and really focus. And I've learned this firsthand. So just to cover, because this is going to be very exciting what I'm going to show you. I'm going to cover this again as an intro. I'm going to show examples of how this can be implemented in your own personal situation. And not everybody may be able to do this, but if you own stock, there's a chance you can. So let's get right into it. So the infamous Warren Buffett $7.5 million in under 5 minutes, what he was doing, he was looking at Coca-Cola stock and he wanted in, but he didn't want to wait for the stock to drop to the price that he wanted to buy, because he knows, he's a very smart guy, obviously, he knows that you can sell put options against a stock that you want to get into at a lower price and buy in at that strike price if it drops to that. And if it doesn't drop, you collect free money, basically. And so the way that works, and this has to do with options trading. This is going to be an options trading video, and really pay close attention and take notes, because this can be very valuable. You may not hear this just anywhere. So when you buy a long call, you're paying that premium to have the right to potentially buy that underlying investment at that strike price. But when you sell it, you're actually selling that right to someone else. So you collect a premium. And not everybody knows this, but when that option that you sell, when it gets to its expiration date and the stock or the underlying investment never reaches that strike price, you keep the money and move on. The thing expires and you keep the premium, because you sold that right to buy that underlying stock at that price. It never hit it, so you just keep it. So, and this is basically what Warren Buffett does all the time. Well, I don't know all the time, but I mean, he does this, obviously. Some people will say, oh, Warren Buffett, he's just a long-term investor guy, he doesn't do options. Well, yes, he does, and he uses them like perfectly. So in this situation, it's a win-win, because when you sell puts like this, you can either have that thing expire in the money where you're forced to acquire the shares, at a much lower price than they were, meaning that something happened for those shares to drop to the level that they had to drop to hit that low strike price. In this case, I believe $35 when Coke was trading for like 40 or so. But chances are, if you pick a low enough strike price in the case of a put, or a high enough strike price, or just the right strike price in the case of a call, as I'm going to show you, you have a good chance of the thing expiring and keeping the premium. And so that's what happened here. That's how he collected $7.5 million in upfront premium, because he sold 500,000 contracts, which gave him the right to like 5 million shares, I believe. And you can read this article on Data Driven Investor. Yeah, 50,000 Coke puts would have given him the right to buy 5 million Coke shares at his desired $35 strike price. So that's the concept. That's what somebody like a Warren Buffett does. And this example has to do with selling a put. You can also sell what's called a covered call, and that's going to be the bread and butter of what I discuss for the remainder of this video. Selling a covered call, covered means that it's covered by a stock or investment that you already own. So in the case of one of my all-time favorite stocks, if not my all-time favorite, Blackstone, that I've talked about before, and as good as this has been for me, right up until now, I didn't fully realize that this was a gold mine for this strategy, because I actually have a lot of shares of this. I bought in at a very low price. I threw a small chunk of money at it, like in 2017, when it was trading at like $28 a share, and it got all the way up to $150 a share. So needless to say, I have about 700 shares of it, which, if you know the basics of options, basically one contract covers the right, it controls the right to basically 100 shares. So any stock in your portfolio that you hold 100 or more shares of are optionable for this strategy. So if you own 100 or more, or in the case of Blackstone, for me, 700, you can basically sell 7 covered calls. And I just learned this more recently, but options are not only expiring when you go look them up on Yahoo Finance and you see certain times throughout the year, there are weekly options. And I actually went to the Ameritrade Thinkorswim app and I back tested. There were 52 of these last year, and that's hence the term weekly, 52 weeks in a year. So that gives you 52 opportunities to potentially make up to $1,000, which is, if you do quick math in your head, $52,000 a year. That could be like your salary at your job. So are the wheels starting to turn yet? I mean, they did for me. So now let's go to the next piece here. So this is Blackstone stock. So the light bulb that went off in my head, and I've been kind of exploring this for some time. I knew there was risk in it, because what I don't want for a stock that's been as good for me as this, that's appreciated like 300% in value, I don't want these shares to be called away from me, meaning that I'm forced to sell them at, the strike price that I pick. So, but I've been following the market a lot more closely the past week or so. And if you look at this stock, I mean, all stocks seem like they bottomed out like May 24th, or that week, around the 23rd, 24th time period. And things have been on an upswing since then, not across the board, but a lot of stocks have been. So following this one, I've been looking, you can see it's hovered around $120 a share. And since the start of this month, it's stayed below it so far most days of the month, except for the end of last week when we had a surge in the market. It got to almost 122 a share. But because of the weeklies, you have like a June 10th option, June 17th. You basically have these options every week. So you can see, since the start of this week, the stock has stayed consistently below $120. So that, I finally decided to take a little bit of a risk here, because I'm to the point, this hasn't been a great year investing, and I kind of want to get things going a little bit better. And I'm somewhat of a risk taker. I wouldn't call myself a gambler, but I think this is actually a great strategy if you can do this right. So, I mean, there's a chance that the stock by Friday on the June 10th expiring call option, there's a chance that this thing could shoot up past $120 and that I would be forced to sell those shares at that strike price. But the thing that some people may miss, you can get out of these actually very easy. You just have to reverse what you did. And I'm going to show you that here pretty soon. You can see, I mean, probability wise, it's probably unlikely we've got basically 2 days left of trading before that expires. That meaning the June 10th call option. We've got until Friday for that expiration. So it looks right now like there's a pretty good chance that this may not expire in the money. So with that being said, let me jump over. And here's an example of the trade made. Because I have 700 shares of this stock, I sold 7 covered call options against this stock at a $120 strike price and collected a $1,000 premium, which I keep regardless. Even if I have the shares called away and I have to sell them, I keep this. So the idea behind this, if me or anyone can do this 52 times a year, that could be $52,000 in what I would classify as passive income, because it doesn't get much more passive. I mean, you gotta follow this a little bit, but you're sitting in front of a computer, clicking a mouse in air condition, not a lot of manual labor involved in that to collect that. And I mean, 52,000, I mean, that used to be the median income. That could suffice as a living annual salary, to be honest. I mean, and this is just one position. So you can start to see the potential the more stocks you have in your portfolio. Any positions that you have over 100 shares in are optionable, because remember, one contract controls 100 shares. Now, unfortunately, there's not like a fractional contract, or you can't buy a half a contract. You got to buy whole contracts, and your brokerage platform won't let you if you don't have at least the money in your account to cover this. You don't want to get margin called. That's the risk. Like if you elevate your approvals for your levels of options trading too high and you don't know what you're doing, you can end up getting margin called, and you don't want that to happen. So that's some of the risk involved with this, but this is why you do the covered call against stocks you already own, because the worst that can happen is that, you know, the shares get called away from you, or in the case of a put, you're forced to buy them. So, you know, in that case, covered, you know, you already own the shares and you're just basically selling them, because you're selling this right to somebody else to buy those shares from you. So let me show how one of these trades is constructed. So basically, if we take ticker symbol BX for Blackstone, and it's going to show over here, let me move my face down here. It's going to show the different positions. And not all the weeklies are going to display, because the weeklies, I believe every month, like the new weeklies populate. So you're not going to look for the year. You know, somebody may try to fact check me and say, well, wait a minute, Yahoo only shows like a July 15th and then a September. I'm not seeing all these weeklies that you're referring to. That's because they're not all there up front. They have to be populated as we get into the next months. So anyway, back to constructing this trade. So this would be call, sell to open, strike price of $120. And this is just with one contract. And here's what's happened. This premium on this has collapsed because the stock is moving in a bearish direction. So the premium on this has collapsed from what I bought it at the early part of the week. So what you're going to see is $42, which is nothing. But if you put the 7 for the 700 shares that we control in this situation, that's $296. And this is good really for the option that I got, because as you can see, I bought it for 1,073, or I'm sorry, I sold it and collected the premium. So as you can see here, 296, that's a difference of $700. So if I wanted to get out of this, if I was really worried about the risk of this hitting $120, I could do the opposite of sell to open. I could buy to close, and then I would be able to close this out, and I would basically keep the difference of $700, or, in the ballpark. But back to this example, if we look at, as you can see, there's weeklies so far for June 17th, 24th, July 11th, 8th, 15th, and they get higher the further out you go because you're basically buying time value. So in this case, time value, or theta, can actually work in your favor. You can make money off of the time decay. Whereas on the other hand, when you buy a call, the theta works against you. It erodes the value of it. So like if we go far out to like July 15th, you're going to see this would be a $3,000 premium if we bought it today. Now, some of you that are realizing the full brunt of what I'm talking about here, you may get ahead of yourself and think, wow, if I can collect that, can I do this one and then do every weekly before? Well, no, because you would have a massively over leveraged position at that point, and you could run the risk of a massive margin call. And that at that point, because you don't own enough shares to cover all of those positions. So your brokerage platform, for the most part, shouldn't let you do that. You can only do one of these at a time. So at this point, if you didn't own the June 10th, June 17th would be the next best option. And as you can see, this premium is about close to where I got mine at the beginning of this week. This is actually higher, $1,227. So today we're at June 8th. So you're talking June 9th, 10th, 11th, 12th, 13th, 14th, 15th, 16th, 17th. That's 9 days. $1,200 in a profit for 9 days is $136 a day. So if you could do that for 365 days of the year, you're looking at $50,000. Or simply put, if you could just do $1,000 and a weekly option premium, if you can just basically use the stocks you already own, sell covered calls against them, you can collect free money, like I'm saying, for 52 weeks out of the year. This could supplement your work income. I mean, this was the aha moment, the light bulb moment for me. I mean, this was mind-boggling. And what kind of upsets me, at least about myself, and I'd say learn from my mistakes, I still have it ingrained in me to be hesitant, just because of life experience, because of, the way I've come up, what I've learned. I'm trying to break that, not necessarily where I become a risk taker to the full extent, but not to where I don't learn something like 6 months ago and then 6 months later come back and say, well, now I finally get this. Now, because you look back naturally and you say, I could have been doing this 3 years ago. I could have paid my house off with this. So you can't knock yourself for what you didn't do in the past. But for me, and maybe my mistakes can help all of you all that are watching this, to, make that learning curve less steep. And in terms of like me, I wish I wouldn't have taken 6 months to actually put this into practice. You could watch me in the car video I did on the Warren Buffett $7.5 million example, and I sound like I know what I'm talking about. And I got the concept, but I just took me to this point to actually put it into practice. So this is what's possible with something like this. And now I'm not sure, I haven't fully back tested if this is worth 1,200 every week, but this stock, and like I said, I love this stock. This is one of my favorite, if not my favorite stock of all time. Because as you can see this nice gain here. This is the price I paid, $29.63, almost a 300% gain. And like I said 400% earlier. That's because it's dropped from $148. It was below 100 not too long ago. Great buying point. But that's why I love the stock even more, because now it's almost like a mini home equity loan that you don't have to pay back, because a home equity loan is a loan that you have to pay back. These are like, if you're sitting on a little gold mine like this and you can use this to leverage passive income, like I say, it's like a mini home equity loan that you don't have to pay back. So like I said, this could really be a game changer. And any stock in your portfolio that you control 100 or more shares of, you can do this. Let me see. And there's a pretty good Seeking Alpha article about this that's almost 8 years old, actually, but the covered call writing strategy for income and intro. And you can read this yourself, of course, but this pretty much sums up what I've been talking about in this video. And this actually has someone else's examples from like 8 years ago. Some of them you can see expired or the shares got called away, but look at this one. eBay shares at this time, 740, 840, 615, 340, 340. They bought one back. They collected a $1,100 premium here. And you can see their profits that they tracked in the spreadsheet here for 2013, 15,000, 2014, 13,000 off 122,000 invested. So that's nice passive income. And if they were really aggressively doing this, they probably could have maxed that out even further. I think that's the gist of what I wanted to show. Hope that was valuable. Hope everyone took good notes on this. And remember, you can watch these videos as many times as you want. I mean, this is valuable information, and take notes as much as you need to. Watch it as many times as you need to. I don't mind. The more views, the better for me, just to be blunt. But it's helpful. It's a two-way street. So if you enjoyed that, please remember to like, comment, and subscribe. And remember, the more you know, the more you grow. Thanks for watching. Take care.